The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and/or through separate funds and may change their holdings at any time.
Welcome, everyone, to a new episode of This Week in Intelligent Investing. Great to have you with us again, and great to have my co-host, Elliot Turner, as well as a very special guest today. Elliot will introduce Justin Fox, but I'm very excited for the conversation we're going to have. I think it's very timely, and I'm sure everyone will enjoy listening to it. So, Elliot, why don't you introduce Justin properly, please?
Yeah, thank you, John, and thank you, Justin, for being here. Really excited for this one. I had the privilege of interviewing Justin in August of 2011. It was shortly after the flash crash, while the European crisis was in full force and markets were still dealing with PTSD from the financial crisis. It was also a time that I, in hindsight, label today as the generational bottom, not because it was the bottom of the financial crisis crash, but because we were not all that far off the bottom of earnings and valuation from the whole dot-com bubble all the way through the financial crisis blow-up. So it was the valuation low of the century so far. And Justin was prescient enough at the time to have called it a really good time to invest, and doing so with the context of the principles that Benjamin Graham's version of value investing was maybe the one tried and true way to approach markets from an investor's perspective. Justin's book, The Myth of the Rational Market, was one of the more formative investment and market theory books I have ever read. Through that book, I was introduced to the Santa Fe Institute and the concept of complexity, and I was left with the strong impression that Benjamin Graham's principles were the best way to think about markets, though they've been tested from time to time. Justin will be publishing a new edition of the book fairly soon, and he has written some really insightful pieces on today's AI technological revolution. One called The AI Spending Boom is Massive but Not Unprecedented, and the other, This is How the AI Stock Boom Plays Out. These are topics that we'll dig into in today's conversation. So welcome, Justin. Thank you for joining us.
Great to be with you after all these years.
Yeah, right. I know. So yeah, to start, maybe 15 years later, what are some of the big evolutions in your thinking about market rationality? Are there any really big evolutions in your thinking?
One of the things that's kind of funny is I sort of stopped thinking a lot about it, especially ever since. So I wrote the book. I started the book when I was writing for Fortune magazine. Then I became the economics columnist at Time. And then not long after the book came out, I went to the Harvard Business Review. And while I was at HBR, I actually kept writing a lot about financial things, because most HBR generally doesn't do a huge amount of that. And it felt like this useful thing. And then I took this job as a columnist at Bloomberg, where I currently, like my desk when I'm in the office, I'm next to Matt Levine and 3 desks over from John Authors. And it's just like, what do I have to add? Let these people write about financial markets. And I've sort of taken off in all these different directions. And then the publisher of the book, Hollis Heimbuch at HarperCollins, contacted me out of the blue a few months ago and said, hey, maybe we should isn't the 15th anniversary coming up? And I was like, actually, it's right now, so we won't be able to have the book come out for the 15th anniversary. But she suggested, yeah, let's reissue it and add a little bit. And so it's caused me to dive back in, read lots of finance papers, start talking to finance professors again. And I'm sort of in the middle of that process. And it's just, I came to this whole topic as an outsider to begin with. I'm just interested in lots of different things. Writing about investing has never been sort of my main thing. And I'm kind of approaching it that way again, coming as somebody who doesn't think about this all the time. And I mean, one of the things that's been interesting, just dipping back into what the finance professors are doing, is it's pretty much continued along the way it seemed to be happening in the end of my book, which is that there had been this sort of great debate and often very hostile relations between the efficient market people and the not so efficient market people, either Bob Schiller or the behavioral economists like Richard Thaler. But you could sort of see there was this younger generation of people coming up who were just perfectly willing to take ideas from both sides. And that's pretty much what finance is now. You look academic finance, you look at who's president of the American Finance Association, what gets published in the top journals, and there's no longer this really strict dividing line between the upstarts and the establishment anymore.
That's really interesting. And, one of the things I was reflecting on, you'd had a slight bit of skepticism on behavioral finance beyond the personal landscape,
Right.
that it's not necessarily this universal law that you could apply as a theory of markets, but it's very compelling in terms of explaining like individual behavior. Have you adapted that view, or do you think
I mean,
some of these
my
new?
the one
Yeah.
thing I'm sort of discovering is some of the behavioral it's almost like some of these behavioral ideas are now making comebacks as useful ways to explain certain things about markets. They haven't all I would have expected more of it to sort of go away, but no, they're I mean, one of the things that just seems to be really well established, and it was this paper by Ulrika Malmendier and Stefan Nagel from like almost 15 years ago, it is sort of the seminal one, but it's just that people's investing attitudes are shaped by their experiences. And so people who've just been through really terrible times in the economy and the market don't have very high expectations and don't want to invest in lots of stocks and other things. And people who've mostly been around during good times are much more eager to. And that really ends up shaping all of these things like the equity risk premium or other ways that finance professors have found to talk about valuations, and that's really important, and I don't know that it's irrational, but it's not some unchanging, perfect equilibrium rational world either.
Yeah, part of what you're talking about, there's the phrase, the collective memory of the market. I don't know
Yeah.
if that was from Irving Fisher first or whatnot, but like when we'd last spoken, I think we both reflected on how it might take a very long time for the animal spirits to come back and for people to get a little more enthusiastic. And right now we're kind of recording amidst what seems like a return of animal spirits.
Yeah, it's definitely not taking as long as it did, after the 1930s, and it wasn't as bad as the 30s, but there definitely is there are these cycles, and they're not perfectly predictable cycles, but they're clearly I mean, what Eugene Fama's word for it is what a time varying risk premia, which is just sort of a backwards way of saying that people are really, eager to take risks in some eras and much less eager in others.
So, a lot was still TBD on the fiscal and monetary policy response to the crisis at the time. Some of it remains, but had been incredibly controversial at the time. And you'd said relatedly that we were in a bit of a muddle about the economic paradigm. So like, do you think we have a little more clarity on an economic paradigm, on appropriate responses from the policy side, or are we still like searching for a prevailing theory that people can get behind?
I mean, there's been a lot more work done on it, but yeah, I don't know how much clarity there is because that's one of the things. I wrote this whole book. It was supposed to come out in. I was supposed to finish it in 2005, and ended up finishing it in 2008, right before things really went haywire, and then adding a little bit because it was published in June 2009 about the financial crisis. And one of the things I got asked lots at when the book came out is, so are the finance professors to blame for the financial crisis? And my general answer was no, I don't think so. We had financial crises just like that before we had finance professors. But one thing that was kind of striking about all of this research in academic finance is how little any of it had to do with financial crises or bank runs or anything like that. And there are definitely people, I mean, I think Marcus Brunnermeyer at Princeton is sort of the best known and most prolific, who are sort of much more looking at that line between financial markets and the macroeconomy and doing lots of research about it. But and maybe as I read more, it'll become clearer to me. But I do remember Andrew Lowe at MIT wrote this I forget who he wrote it for. He wrote this review of a bunch of books about the financial crisis, and he said that sort of the most striking thing to him was they all had different explanations for it. And so that makes it a little hard to know exactly what to do. But it's clear that there's this moment when there's sort of debts that can't be paid back, that you end up in these bank run situations where all sort of the normal rules of prudence and what people how people should behave go out the window, and you can either have some backstop, a central bank, or in past eras a JP Morgan, try to sort of stop the panic, or you have really terrible side effects, which is kind of what happened in the early 30s. And I think a lot of it is just remembering that, oh yeah, okay, that can happen. We forgot about that. And and definitely it's still not sort of the mainstream of what finance scholars are doing, but there's definitely much more looking at what causes things to break than there was before 2007, 2008.
Yeah, it's interesting you mentioned Andrew Lowe in that context because my first exposure to him was the paper that he published on the quant meltdown, which happened not too long before the financial crisis. And I almost feel like it got lost because of the gravity of the situation thereafter. And he'd since published the adaptive markets theory, like he
Right.
published a book about it. And it tries to kind of synthesize, I think, some of the evolutionary biology nature and complexity into a prevailing market theory. Is that something that you'd found to maybe address some of the pitfalls of prior synthesis approaches?
I mean, and definitely one of the interesting things with Andrew Lowe is I think what a lot of what he's done over the past 25 years is sort of pointing out that a lot of the old folklore of the markets, even though it was often kind of unsophisticated, the chart readers and other things, they were usually onto something. And it was something that gets lost again if you have just this sort of perfect markets view of prices are reflecting all information, and that's all that they're reflecting. I mean, what I think what's happening is prices do a really good job of reflecting information and changing when new information comes in. But obviously, since this is all betting on the future, you could misinterpret the information, and then there's just that whole thing of changing risk appetite over time. So, I mean, one of the things now is I sort of the way when I was writing the book, I kind of had to choose people to focus on, and there's so much. It's such a big field now that I'm a little struggle. What I'm going to try to do for this update is add a chapter about what's been going on in academic finance over the last 25 years. And I mean, one interesting thing that's happened is several people who are play major roles in the story in my book went and won Nobels in economics. And sort of the most striking one was Bob Eugene Fama of the efficient market hypothesis, and Bob Schiller, who called the efficient market hypothesis the most remarkable error in the history of economics, got to share, got to go up on the podium together in Stockholm and get their Nobel prizes. And neither seemed to mind it at all. They seemed to get along fine. And so there's that, and then I'm adding a chapter just kind of about developments in markets since the financial crisis. And it's like when I'm looking at how much is being written and what's out there, I am definitely still struggling at this point to figure out what the theme is in terms of what's gone on in academic finance.
Yeah, and it's interesting because I feel like academic finance has approached markets as a separate question than economies.
Yeah.
But there's increasingly this kind of I'm not maybe it's always been the case, but I think there's this kind of like connected nature between the two, and they're in a feedback loop and a dance with one another. So that's I don't know. It probably seems more pronounced today than in past.
Yeah, and I mean, I think people always realize that, and there was like Larry Summers made this famous speech about ketchup economists and economists of ketchup, and basically the finance professors were ketchupable economists, and all they did is just focused on the price of ketchup, and the other economists were interested in how ketchup fit into the broader economic system. And Summers' critique, and this was like in the late 80s, early 90s, was that the finance people in business schools, the finance professors in business schools were just too laser focused only on not just markets, but especially equity markets, which just are unique things and they're very important things. But their characteristics, like one of the really important things about like the way the stock market works is that everybody's always trying to get more information about these stocks that are being traded on it. And I think that this other parts of financial markets like bank accounts, you actually don't want people out there looking for information all the time about how safe they think their banks are. And that was Gary Gorton, who had sort of quietly been studying this all along, and everybody else in finance, thought whatever, he's this kind of weirdo doing his studying bank runs, which we know we don't have anymore. And he, with the financial crisis, there was much more attention. And his big focus is there's a bunch of things that's really useful for them to be information free. Bank deposits, treasury securities. And I mean, I think we're approaching we seem to be in a lot of the Western, well, not just Western, developed countries approaching this point where people may have to start thinking harder about, what those government bonds are, what the risks there are, and they're not just these magical risk-free instruments. And I just it's the kind of you study one thing and you want to sort of interpret everything in the world according to that one thing. And if you start looking at the intersections between finance and the economy, it gets more complicated and you might not have all the answers. And so it wasn't popular for a while. Obviously, what happened has caused a lot of younger scholars to spend much more time on that. But I don't know that how clear a consensus has come out of that.
Well, it's so interesting on the bank account situation because just 2 years ago, we had a moment that,
Yeah.
many thought might be more than just a moment at the time, where people actually started looking at their bank accounts and asking, why is this a bank not paying me interest when interest rates are, we have interest rates again after a decade plus of not having them. And, it had an effect on the stock market. We had I don't know.
Well, and they were also it was a bunch of people who had like, you know, $100 million deposits at a bank and were thinking, oh, why am I doing that again? Because, they're not insured. And so that seemed to be a big driver of it as well.
So, one notion that stood out from our last conversation, I think it gets into this market structure and asking questions, right? In the wake of the flash crash, we were talking about ETFs and the role they may have played. There were no real answers on what exactly had happened then, but you said something to the effect of like, if we reached a point where most investment is done through passive vehicles, then the market will become less efficient because we'll have fewer people trying to figure out what things are worth. So since then, ETFs have become, I'd say, exponentially more dominant.
Right.
Do you think we've reached a point where we're losing some efficiency in the market, or is efficiency like some kind of asymptote where you could keep getting closer, but never exactly there?
I mean, I've been reading a lot of what's been, recent research on this. And I think one pretty good argument is that a, a lot of the sort of active managers that have been forced out have been kind of the bad the closet indexers, basically. And seems to have been a lot of research done, like the idea of looking at a fund's active share, and that places with a high active share show some signs of people show some signs of actual investing skill and beating the market. And then another fun study from about 10 years ago was basically mutual funds that are sold through like Fidelity or Vanguard, big marketplaces where there's not a big sales job, actually do pretty, perform pretty similarly to or slightly better than index funds. But mutual funds that are still sold by brokers tend to underperform because, they're being sold. So they don't need, it's not as important to be good performers, I guess. And so I think a lot of there's a lot of people in academic finance now who argue that, well, actually, we mostly forced out the bad investors, and there's still a lot of good, very smart investors. The issues are more other things. Like one that came up a lot a few years ago was this sort of antitrust implication where when every large company, the biggest shareholders are basically BlackRock and Vanguard and State Street, they're indications that that just causes different behavior. There are some papers claiming that it leads to less competitive behavior. And then there's a brand new paper out of Stanford that a couple of young economists arguing that the rise in indexing has led to basically beta, the sort of every stock's covariance with the market going up, especially for kind of middle market stocks. And because CFOs use beta to calculate their cost of capital, it's causing companies to do less in sort of that middle section of the market, to invest less. And then there's this whole new, I don't know how far it's going to go, but Ralph Cohen at Chicago and Moto Yogo at Princeton have this demand-based asset pricing where they're looking just really at fund flows and stuff to explain price movements. And their general feeling is that index funds make markets a little bit less elastic. So they basically make it so that when somebody suddenly decides to buy or sell a bunch of a particular company, it causes prices to move more than would have happened in a pre-index fund world. All of which are things that seem not totally awful, but they're all kind of interesting. So there seems to be less concern about smart investors no longer driving prices at all, and more about it having other impacts on the market. Basically, most of them having to do with this sort of shared ownership of every large company.
Yeah, no, that's really interesting. One thing I've observed and noticed, though, kind of alongside these trends, is that, and I've seen it quantified well, single stock volatility is considerably higher now than it was a decade ago. And the average earnings move is decently greater now than it had been in the past. And then, with ETFs, we often associate ETFs with passive investment, and they've been amazing vehicles on that front. But there are also a degree to which ETFs cater to far more speculative behavior. There's
Right.
an ultra long and short for everything. And relatedly, you've seen a lot of retail participation step up in the market in recent times. Like, do you think those are I mean, it might not be one answer to all of it. Are some of these secular forces or some of these cyclical forces? Like, do you think those matter in terms of the efficiency of the market?
I mean, I didn't know about the single stock volatility and the earnings volatility, so I really don't have thoughts on what's causing that. With ETFs, I mean, there's this constant sort of, well, how will they behave in a real stress situation? And I mean, we had pretty stress situation, and there were a lot of ETFs 15 years ago or 17 years ago. But who knows? I mean, there could be, especially with all these increasingly weird and focused ETFs, there could be issues with that if the market moves very suddenly. But yeah, it's strange. It's fascinating because indexing and just sort of passive investing, I think the arguments for it, people were making the arguments why people should invest that way even before the efficient market hypothesis, but they weren't getting anywhere. And I think it was this combination of suddenly having all these finance professors arguing that it's stupid to put your money especially with some go-go money manager like in the 60s, and the combination of that with how everybody investing in the stock market was doing terribly in the 70s. And then you had this weird situation at Vanguard where Jack Bogle was trying to keep his job and therefore kind of reinvented Wellington Management, which he had been in charge of, into this truly mutual fund company that was focused on keeping costs low, which wasn't really what most of the rest of the industry was doing. And one fascinating thing is that Fidelity, which, in the was all sort of the archetype of the 1960s, we're going to put up these amazing performance numbers by taking crazy risks. Fidelity has become something that provides services a lot like Vanguard's. I mean, you can buy the performance funds, but it's also a ton of index funds that give very low cost services, cheap brokerage services. And so, I mean, it's hard to get mad about that. It seems like that's all a great development, and definitely for this sort of large upper middle class investors, they're much better served than they were by the way the world worked before Eugene Fama wrote his Efficient Markets paper, and I think Fama is partly responsible for that. But obviously, you have a big shift like this, and it's going to have side effects, and I don't know what all of them are, but I think that there's more and more research on what some of them might be.
And how do you think about the degree of concentration in the market and what impact it has on active investors, on market efficiency, systemic risk? We have like 40% of the S&P is represented by the top 10 holdings. It's supposed to be
Right.
500 diverse securities.
Yeah, and I mean, I think there's been some. I know Renee Stoltz at Ohio State has done some research on this, and if you look back to like the 50s, a really high percentage of the value of the S&P was in AT&T and T and a few other companies. So it goes in waves, and I'd be curious if there's, what sort of evidence there is for, is the market going to underperform after this? Because what the sort of historical thing that everybody has in mind is the Nifty 50 of the late 60s, early 70s, which were all these can't miss stocks that came to comprise a bigger and bigger part of market the market's capitalization, and almost all were kind of terrible for a decade after that. Although so was everything else, so I don't know that they were particularly bad. But yeah, I mean, clearly when that happens, it just means that one company going astray can have this huge impact, and B, it sort of raises questions about, well, what's going on with everybody else in corporate America.
Yeah, and it raises questions about what it means for the market to work or not. As
Yeah,
in, historically, the largest companies tend to underperform the market. So if we'd entered this period where you're excessively concentrated and the large companies underperform, but everything does pretty well, the market might look bad, but stocks could look good.
right. Yeah, and I mean, just generally, the sort of freezing up of the public company pipeline in the US over the last 25 years. And who knows if maybe index funds have something to do with that too. I don't know. It seems like it's other factors, but that raises questions for people who are invested only in public securities, which is most people. And I I don't know where that goes. It doesn't seem great, but I'm not sure I buy like Paul Atkins make make IPOs great again campaign. I'm just not sure he has identified what is actually reduced the number of public companies. I don't think it's just because people can have stupid proposals at your annual meeting. At least especially for larger companies, those are a nuisance, but I just don't I think they're a pretty minor cost overall. And they may even be this nice sort of release valve for anger at corporate America. You sort of get it out that way and don't have to worry about pitchforks and torches in the streets.
I mean, isn't part of it just how easy it is to access capital in private markets nowadays? Like formerly, you had to go public to raise prodigious amounts of capital, and now you basically don't. You
Yeah.
could almost raise money easier not being public.
Yeah, no, that's definitely clearly that's a really big part of it. And I don't know how to think about like this idea of, okay, so then let regular people access some of this in their 401ks. Eh, I just my main concern about that is we're likely to get the dregs of private equity and venture capital and everything else. So yeah, I mean, and I'm very dubious about a lot of the things that have been very popular among private investors. I mean, I just like, but you look at something like SoftBank, and it just seems like kind of the whole thing just seems like a joke. How Masayoshi Son has invested, but he's still above. He hasn't gone under, and he's made. So I guess he makes enough on the things that work to make up for the kind of ridiculous for the WeWorks.
All while doing it in a publicly
Yeah,
listed
within it. So I guess
trading
in that
firm.
sense, he's giving us access to those markets, so that's something.
Yeah.
Although yeah,
And in terms of like giving more people access to these private vehicles, the notion of volatility laundering that Cliff Asness talks about, and it seems like a lot of the excess return isn't really excess return. It could be explained by leverage, and you just don't have to wake up in the morning and look at your mark. And your
Right.
mark itself might create certain behaviors that are counterproductive.
Yeah, I mean, I think the concern is just then you hit some moment where whatever the private equity firm has been valuing things at is so clearly wrong, and then you have a very scary situation. But yeah, I think Cliff is very funny about those things on social media and such. I think he's right. It's clear that there's lots of very smart people in those areas who've made lots of money. It's just less clear who else gets to make money alongside them going forward.
I can't remember if it was in the book or in our conversation where you talked about the Santa Fe Institute simulation of decision-making process in traders, where
That was
when
in the
you
book. It was Brian Arthur had put together a pretty early simulation. And I mean, one thing that's really interesting going on now is sort of conventional finance people are starting to come around, partly because it's so much easier with machine learning and AI to looking at kind of throwing lots more variables into a model to try to figure out which stocks to pick. this the whole nonlinear Santa Fe thing is getting more practical. And I mean, Doan Farmer has a new book out I think it was last year or the year before, and he's much more optimistic about all of this stuff actually catching on than he was when I talked to him for the book. And it makes sense because there are these, I mean, the interest, like Cliff Asness has been pretty gone from being very suspicious to pretty gung ho about AI and machine learning and investing. And I think a lot of it's really hard to say what exactly these things are doing, but they're just finding signals in the market that a human wouldn't be able to and figuring out how to get in. I mean, in a way, it's sort of that's what LLMs are doing with all of the knowledge out there already. So why not let them try to do it with stock prices for a while?
Yeah, I'd been joking that over the last 5 years, we're living in that sped up decision-making process between the COVID crash. What does it look like when everything's closed to reopening to, are we going to close again when there's the Omicron wave and everything's fully reopened? And, there's been so much drama and so many changes. I feel like increasingly investors, the fundamental kind who are still around, obsess about second derivative far more so than fundamental value. Like, what's this worth as the true North Star? Because of that, are we creating a new type of risk in the market with how rapidly things have been progressing?
Yeah, although it's hard to say like with because the pandemic was very strange, but it happened and then it's over and it left all sorts of consequences, a lot of them having to do with sort of working from home and commercial real estate, but also just people's attitudes about the world. It I mean, one of the things I think people really struggle with is this sort of range of possibilities with AI. It's kind of like with the internet. Okay, it might be a big deal. It might be a smaller deal. Like in the late 90s, you could sort of see it seemed easier to envision what it was going to be like. Whereas with AI, you've got the people who saying that if we don't watch out, the machines will kill us all. And then there's louder and louder small minority saying that actually they've peaked already and they're just going to keep getting worse and worse, that they because they hallucinate so much and they have so many other problems that just the basic technology is reaching its limits. And so it to me and then there's lots of people out in Silicon Valley sort of feeling like, well, this is the last big chance to be in on something big ever. And so there's this sort of mania around that. So I don't know that it's that we've sped up, but it's harder to see what the long run is, I guess, for a lot of people. And I think that's understandable. And I mean, another but on the side, and I don't know where exactly the impetus for it has come from, but you have on sort of the smaller thing, the occasional meme stock frenzies, which in some ways just feel a lot like late 19th century, people pumping and dumping stocks and stuff. But that's interesting that that's had this whole comeback. And then the other is just, I mean, cryptocurrencies. And that's funny. I've listened to a couple of interviews with Fama, who is generally very loath to say anything is in a bubble or crazy, and he just doesn't know what to make of crypto in general, and keeps thinking, he'd sort of like, okay, if Bitcoin keeps just going up, then clearly a lot of things I thought I knew about financial markets are wrong. And so one thinks that a lot of that whole ecosystem has to collapse. And more than Bitcoin, just all of these meme coins and stuff that are completely, there's no intrinsic value whatsoever. I mean, there isn't really intrinsic value in Bitcoin either, but at least there's this scarcity that's been imposed, and enough years now of people believing that it's the digital gold, that maybe that holds on. But all the rest, it just seems so clearly like something that's not built to last.
Fart coin shouldn't have value, you're saying?
Yeah. I mean, I guess they can for a little while, but you shouldn't expect them to have it like in a year or 2 years. Maybe they will, but you shouldn't expect it.
Yeah, it just keeps going on, and it's definitely something that you start questioning certain theories of markets and certain behavioral realities of how people act, because you'd have to think the average person knows better than to think something called fart coin has value, yet people still
Right.
trade in it.
Yeah, and I mean, I guess it's just it's the last one out, ends up holding the bag. And I think a lot of people in the meme coin space, people sort of realize that they're kind of very transparent Ponzi schemes, basically. But I don't know. There's people who spend their lives doing that and have made a lot of money doing that, and then other people see it and think, oh well, okay, that's better than holding an index fund of U.S. stocks. So I don't know. I feels like that's just this thing that's clearly headed for a collapse, but it hasn't happened yet. So I mean, it's happened a little bit this fall, but it hasn't sent everything crashing down yet.
Yeah, as we're recording, it seems like there's a hiccup in that space at the very least, and
Yeah.
maybe people are getting a little more suspicious.
I mean, it just because in the end, with all financial assets, the idea is always that there's some you have some claim on some resource, you have some claim on some payout. And with the meme coins, there just isn't any. There is absolutely no underlying thing that's supposed to generate money that, if it's not, if people don't want to buy it anymore, you can just go back and consume whatever that thing is, be it dividends or the value of gold or whatever else. It's just not there. And that just has to end.
So the other boom in markets nowadays, the AI mania or frenzy or whatever you want to
Right.
call it, like, do you think that starts looking like a bubble at this point in time?
I mean, I struggle with that because clearly it it's it's mostly companies that have a lot of their own cash flow doing it, although obviously OpenAI does not. And it's clearly delivering this product that lots of people use, although people don't pay nearly enough for it to to reimburse all this investment. I mean, it seems like a classic technological investment boom, and those almost always turn into, they overshoot at some point, and people end up holding the bag and losing lots of money, but you usually end up having some valuable technology afterwards. I think one of the interesting things with AI is it's like, well, it's not like those chips are gonna that everybody's paying all that money from are gonna still being used in 100 years like railroads are, and fiber optic cable from the internet bubble are still being used now. And so all that spending may enable these leaps forward in capabilities that will then eventually lead to a more sustainable and very profitable business in large language module, but the actual money being spent on the data center seems to have pretty rapid, pretty short shelf life. And so I struggle with that. So I just don't know. I mean, one of the big questions is kind of, is this 1997 or is it 2001? And it feels like it's not quite 2001 yet. I mean, one big argument is, there's so many people still questioning it and calling it a bubble that it maybe isn't yet. You got to wait until all those people have been driven out of the market, and then you finally get the moment comes where it all falls apart.
Yeah, I reached out to you after your article where you try to quantify the spending boom and put it in historical context.
Yeah.
And, you kind of concluded that it hasn't reached the point of major economic significance yet.
Yeah, I mean,
Sorry, has
because
reached the point.
it
Did I
has,
make sure I said
yeah.
that right? But it's not the same as prior investment booms. It's not as big as fiber, not as big as the railroads. So, yeah, help us put it in context. And do you think it kind of has to reach that point in order to become something more problematic?
I mean, the railroads is really hard to. They were like spending 6% of GDP on building railroads in like the 1850s or 1860s. And it's partly just there wasn't that much, there wasn't an industrial economy beyond that at that point. It was all, we were still this agrarian country. And it just seems really unlikely we're going to get there with AI. I mean, just looking at sort of, it depends how you slice it. If you include all software along with all technological investment, it's about 4% of GDP. But if you're sort of restricting it to actual money people are spending on data centers and stuff, it's more like 1 or 2. I mean, one of the issues is that when I did that whole thing, I wasn't looking at the money being spent on power generation. But I also think with power generation, that's an interesting thing where it, lots of people have been predicting we're going to need, even before this AI craze, lots of people predicting we need a lot more electricity generation if we're going to switch to electric cars and switch more to electric, like heat pumps instead of furnaces. And even though those things seem to be sort of on pause during the Trump administration, I think those are forces that are going to continue, partly because electric cars and heat pumps are just so much more efficient than the fossil fuel driven ones. And they keep getting more so. And so I think it'll be nice to have more electrical power generation. Although one interesting thing is that these data centers need sort of always on generation. So they aren't helped all that much by wind and solar, whereas a lot of the other power needs can be satisfied by the wind and solar. But it still feels like investing a lot in electricity, even if AI turns out to be a total bust, it'll be nice to have all that electrical generation capacity.
Yeah, that's a really interesting thought. We just got our first EV, and it seems like the cost of ownership over time is a lot lower too, without oil
Yeah.
changes and everything else. And so I guess part of what you're getting at is that if we do overbuild something, it looks like it might be electricity. And so if costs go down long term and we don't really fill it, we're going to have second order consequences that are quite beneficial.
Yeah.
Because we
Yeah. And
can't
that,
really have those with GPUs. Maybe Instagram could serve us more videos, but
yeah, exactly. It's sort of, what are people going to do? I mean, we'll be able to, maybe people will be, putting the things that are going into data centers now will be in your car in 15 years, because that seems to be sort of the life cycle with chips. So we'll have cars that do amazing things. So I don't know. I it it's just the classic thing. I don't think it's stupid for these companies to be investing lots of money in this. At some point, they're going to overdo it. And so
well,
I don't.
yeah.
I mean, somebody who has to. I don't do it professionally, but I have like retirement money and other money that I decide what to do with. I mean, my general feeling is I'd like to tilt my investment away from those guys, even though, and be in that part of the market that hasn't been doing well for the last couple of years. But overall, yeah, I wouldn't be. I mean, I'm barred by my job from selling short, but I wouldn't be doing it anyway, just because it's
Yeah.
hard.
That's one of the most interesting points about this notion that GPUs have a much more finite lifespan than rail lines and fiber. And, every major tech revolution has, I can't think of one that did not overshoot in terms of overbuilding capacity relative to demand. But meanwhile, you listen to the recently passed earnings calls of Google, Amazon, and Microsoft, and they're telling you that they're supply constrained right now. They have more
Right.
demand than they do supply. And they're telling you, like Google, one of the GCP people was on a podcast recently and talked about how they're still using 8-year-old TPUs at 100% capacity utilization. And those are presumably fully depreciated for the last half decade. So, like, there's economic life even beyond that 3-year
Yeah.
period, even if we think of them just having been around that long. So, I mean, maybe the question is like, given those signals, like, is there a degree to which maybe it's a twofold question? Might these companies have better signals on the demand side so that demand and supply end up better balanced throughout the entire ascension of this technological revolution? And so markets are thus more efficient because it's very concentrated in a few very large, very sophisticated hands. Can we avoid building that excess capacity with like no, Soros always says there's always a bust that follows a boom, but like, might we avoid the bust because of that nature?
I mean, I doubt we'll avoid a bust ever, but it might mean the boom goes along for a while longer. Yeah. That, you might have markets have a correction, but not some big like in the early 2000s where it just all sort of unravels for a while. And I mean, the internet thing was just sort of the classic thing where all the predictions were right. It just the particular company, a lot of the companies that were doing it initially weren't the ones that were going to rake it in. And that, in a way, it's almost kind of sad that it's like, well, now we sort of know who the companies are, at least right now, it seems like, who are going to be benefiting from this. I mean, I guess the one possibility is, they'll never be able to raise their prices enough to really benefit from it. And so the rest of the economy will be what's benefiting from it. But yeah, I also think we're in this sort of media and political environment where everything just feels especially apocalyptic. And so I think there's just lots of people who are willing to kind of put the worst, and I'm one of them sometimes because it's just the sort of leaders of Silicon Valley are not as warm and fuzzy and appealing as they were 25 years ago. And the political leader Washington seems much less functional. And so I think and I think there are reasons to worry about all of those things. And I mean, I guess just one thing with all the, I think Google and I mean Alphabet and Meta to some extent and Microsoft seem to know what they're doing to some great extent. But then there's Elon Musk, and I just have no idea at this point. He seems, he's somebody who's taken his main company and kind of destroyed its business over the last year. And yet markets are still banking on him succeeding in whatever the next big thing is. And that just feels it's like Musk and crypto are the things that, I wouldn't be sure. Who knows? I could be wrong. But if you were sort of point out now things that are probably going to look really dumb 5 years from now, I'd say it's Musk and the crypt and meme coins, and of course Musk loves meme coins. So there you go.
The two are match made in heaven.
Yeah.
When you think about like the hallmarks of .com and that era, I always point to this book from the great Twitter personality, Modest Proposal, this book called Effed Companies. And you read about those companies. I mean, ironically, a bunch of them became great business models today, but the truth was at the time, they were just ideas. They had no revenues. They were going public. And these IPOs of profitless companies were consuming massive amounts of cash without any business models. And here we are today where by and large, and by the way, even the telecom companies at the time, though they weren't IPOs and they had business models, they were completely reliant on the benevolence of strangers insofar as they needed debt markets to fund
Right.
their own CapEx ambitions. And you'd pointed it out, but here today, it's by and large being funded with very good business models, like very cash flowing business models. And these companies are still cash flowing. So like, where do you think the excess comes from? Do you think we're seeing the first signs with like Oracle and some of the proclamations from Sam Altman recently needing, government backstops to certain debt finance for like, or something like CoreWeave? Like where do you think that comes from? We haven't seen those IPOs yet.
Right. Yeah. I mean, and I think OpenAI would sort of like to do an IPO down the road, and it will be just staggeringly large. At least if markets continue the way they're doing now. I mean, it does seem like if you're looking at what could really, it's OpenAI and it's sort of the companies that are coming in a little late to be in on the whole gravy train. And Oracle, I mean, one of the things when I did the column on comparing this, investment boom to others, most of my charts were like, yeah, that's not big compared with the past. And then I look at Oracle's capex as a percentage of revenue. And I mean, Oracle's been a software company for most of its existence. It doesn't have very high capex. And now suddenly it's like almost 50% of revenue. And it seems like a really big bet for a company that this is not their sweet spot or hasn't been at least. And so you sort of see something like that and I'm like, Whereas I mean it's kind of fascinating. Like Alphabet and Meta have been their current capex isn't really out of line historically relative to their revenue. And Microsoft is up because Microsoft is, but it sort of that actually happened a while ago because when they became a big cloud provider. So in the 90s and early 2000s, they were basically just a software company. So they had very low capex, but they've become this infrastructure provider more recently. So they need to do more. And so, yeah, and I don't know, I haven't followed CoreWeave closely enough, but yeah, clearly some of these companies that coming on the fringes, they're just higher risk. They might work out, but there's a pretty big risk that they won't work out at all.
One of the things that I found really interesting in your second of the recent articles was that Pastor and Veronese,
Yeah.
hopefully not butchering the pronunciation too much, but like it seemed very counterintuitive to me that as booms play out, PE ratios fall. Because we're often told as investors, clarity and visibility lead to better, not worse valuation. So yeah, what do you think of that paper? Like that, does that seem to make sense intuitively, or is that a
It
paradox?
doesn't totally make it sense intuitively, and that was sort of the attraction of it to me. And a lot of it is kind of built around just the way the if you do a basic dividend discount model and plug growth into it, if you sort of look at your expected return, it actually if there's more uncertainty about where things are going to end up, your expected return is higher just because of the and now I'm like, is this concave or convex? I can never remember. But just the way the curve works, and it's a fun result. I don't know that it means that that's actually true, but it's a cool sort of just the way the dividend discount model works. If you plug the numbers in, if you have more uncertainty about where it's going to end up, you end up with higher prices that you're willing to pay. And then
And
that was one of their things, and the other that sort of explained tech stock bubbles in the past. And then the other was just this sense that, when things are starting out, and again, this is something that's kind of different with the AI thing because so many of the companies are already central companies in our economy. But definitely with like the 90s dot-com boom, it was all these weird little companies doing their own thing off the side, and it had very little impact on the overall economy. And then as some of them grew and like Yahoo became the new blue chip and stuff, they started having a higher beta, and we're just moving much more with the overall market, and we're no longer idiosyncratic. And that sort of was what caused PEs to fall because you were now just talking about systematic risk in these companies rather than these sort of fun flyers off on the side that you could use to diversify. And that was sort of their second argument.
is
And
that different?
well,
Oh,
go
go
ahead.
ahead. Sorry.
No, I don't. I didn't. I'm not sure what I was going to say. So you go ahead.
Is that different now because, like we talked about before, 40% of the S&Ps in these 10 companies, predominantly these AI companies, so they almost are by definition
Yeah, it
beta. They
seems like
are the
we're already
systemic
there. I
risk.
mean, one thing Pastor and Veronese and others have done is just looking over basically since Chat GPT what was it, GPT-3, I guess, was released, that sort of the first big consumer product from them, that since then, the beta of sort of every AI related stock is much higher than it was before. and that sort of fits their model perfectly. But yeah, it's not, that's been a pretty quick, that was sort of sudden, and it's just been a year or two. It's not like this decade-long phenomenon. So that'll be, I mean, that's one interesting thing. It's just maybe we're, even if it's not a bubble, and maybe it'll prevent it from being a bubble, is just this sense that since it's already big companies doing it, we won't get quite the same level of just extreme optimism about prospects that you did with all of these money losing internet companies back in the day.
When you talk about the impact on the economy, right? You'd quantified it somewhere around, I think it was 1.3 or 1.4% of GDP, was similar to Kudrowski's number at 1.2. When you looked at these past historical tech revolution booms, is there a multiplier effect on the economy where these tech booms have led to better economic growth outside of their own core area, or do they suck the air out of everything else? And so they kind of consume so much capital that there's this inability to invest in other areas.
Well, I mean, having worked in the business media space in the late 90s and early 2000s at Fortune, they were definitely, we were definitely benefiting from that in a huge way. And you could sort of feel the overall US economy was definitely, there were lots of places outside of tech that were benefiting from it. It feels a little less like that now. It's sort of like all the investment that's going on is just this. And maybe that will, I think there's clearly an argument for that changing as more and more companies figure out how to use large language models to do things more efficiently. Then you would expect that to have this broader positive economic effect, although possibly lots of dislocation along the way with people losing their jobs and other difficulties. So but it feels like right now the investment boom is mostly, I mean, some of it is when you spend that much money, some of it trickles out into the rest of the economy, but it's so focused. I mean, one of the things that strikes me is I just remember went out to the Bay. I'm from the Bay Area originally, and I was out there a lot in the late 90s, and it was just kind of fun, the whole thing, and all the billboards along Highway 101 about all the tech companies, and they're like addressing so many different things. It was really like, wow, this is kind of this fun revolution going on that we're all going to benefit from. And you drive around there now and it's all the billboards again. And they're all these incomprehensible AI companies. That's all it is. It's like, what are they trying to sell me? And all the billboards, they tend to be very dark now. They're all in sort of like dark backgrounds with, and it just feels sinister. And I don't know that it actually is, but it's just this total change in the sort of attitude that Silicon Valley is spreading out to the world, and that I think as a lot of people are perceiving it. And in the late 90s, it was just like, this is this fun thing that's going to empower us all. And it may be that that's what AI will do too, but that's not how it's being sold. Except Palantir is running lots of ads. I was just listening to my colleague Joe Weisenthal and Tracy Alloway's Odd Lots podcast, and there kept being these just over the top Palantir ads about how great things were going to be because of Palantir. And I have no idea how Palantir is going to make things great, but for the most part, that's not what the AI boom is giving off. That's not the vibes it's giving off for people.
Yeah, no, it's interesting. I think maybe I don't know, I'm kind of thinking out loud here, but like the internet boom, it was so vague and so abstract and it was glorious, but the AI boom is very tangible and people can actually use it today. It's far easier to deploy than the internet, right?
Yeah,
The internet was like, I don't know, everyone had an internet strategy, but like who even knew what that meant?
right.
Barnes and Noble spinning off a company maybe, or like, Palm trading at more than the entire 3M ownership. But like these things were not specific. Now they kind of are, but maybe Palantir is an exception where I think the average person invested in Palantir couldn't even tell you what Palantir does.
Right.
And that might be what you need to kind of take it to the next level of crazy, if you will.
Yeah. Yeah.
Um,
I mean, it definitely feels different, but I don't know if that's means it's less less risky or more.
or we're in the earlier innings or
Yeah. Yeah. Earlier stages of it.
I thought it was interesting the P&V simulations, for lack of a easier way to phrase it, Pastor and Veronese, that showed that in some booms in their simulations, they just keep going up. Like, what unique combination of economic factors would be required for a boom to follow the non-average simulation and just, like, go?
Well, it's interesting, and this is something I may write about later. Is Robin Greenwood at Harvard Business School has, and with a bunch of co-authors, has done a series of papers just sort of looking, not building a model, but just looking at past bubbles and crashes and what aspects of them were. And the initial one was this paper. It was called Bubbles for Fama, because I guess in his Nobel address, Fama had talked about how nobody, people talk about bubbles, but I want to see some evidence that there's some way to predict that it's a bubble that's going to end badly as opposed to just prices going up. And they found lots of episodes in the past. And the one they brought up was, I guess, sort of the pharmaceutical industry in the 50s, I think, had this incredible run up. And then it just kept going up in the 60s. I don't think it went up as fast, but prices kept rising. So that happens sometimes.
That's an interesting example. Like, could you think it's hard to think off the top of my head what would have catalyzed that to persist versus other ones. When you think about this notion that the biggest question here is railroads last forever, GPUs burn out eventually. Pharma seems very much closer to the GPUs burn out
Right.
kind of business. You run out of patent exclusivity and someone else just copies it and you all of a sudden lose.
I
And
mean, I think they
today,
might have been starting from a very small base. And so they had pretty good performance in the 50s, but not that many people were investing in it yet. And it wasn't really a major factor. And so it was able to, as they kept figuring out how to produce new drugs, they were more and more successful. So it may be that, what with Google and Alphabet and all, I keep calling whatever I'm supposed to call them. They're so far along already that you can't really. I mean, that's what, like, one of the classic things with Nvidia. It's sort of great company, done really well, but if you sort of extrapolate from what its valuation is saying about its future cash flows, it just seems kind of unreasonable. And I mean, the thing that it feels really similar to is Cisco in 99, 2000. And I remember Cliff Asness writing some whole paper about how, maybe you could justify pets.com or whatever as this gamble in a one in a million shot. But Cisco is already this big profitable company, and it was priced at a level that you were just assuming just impossible amounts of growth going forward. And it's turned out to be a great company that's grown a lot, but I'm not even sure if it's back to its 2000 price yet. I'll have to look at a chart. I don't know.
today,
Really?
literally today's the day.
Oh, that is so funny.
Go figure, right?
Yeah. I mean, that's a long time.
Only took a quarter of a century.
Yeah.
Yeah, no, I don't know. I'm thinking off the top of my head, but maybe, not all companies in the AI world are to be painted with one brush. This example of the pharma companies, you think about Eli Lilly is like one of the poster children of that rise. Like, they were really a chemicals company. They'd been around for a very, very long time, and they stumbled into this very interesting new use of a chemical
Right.
to save people's lives. I not a perfect memory on this, but it might have been for like leukemia for treating that. And so, it seems a little more akin to something like Alphabet slash Google, where like search kind of lends itself pretty nicely into AI. They've been investing in these capabilities that kind of powered their search, and then it takes on a life of its own.
Right.
But in contrast, something like NVIDIA, they've always been a cyclical from their first day in business. They've had numerous instances where their revenues were down by over half year over
Yeah.
year. Like, I think the most recent being just 3, 4 years ago. So it does feel like maybe, not all companies are created equal in this.
Right. Definitely. And I mean, it is fascinating with Alphabet. It's like the rap on them for so long was they couldn't figure out a second act. And I don't know if they've really figured it out, but at least it seems like this is more something than anything else they've come up with. They invested so much money and did so many cool things, and all of it was sort of a rounding error relative to their, selling ads on searches. Um,
Yeah, it's a high class problem when you're so big that creating $1 billion market doesn't really move the needle. But
right.
that's exactly right. One of the things I loved in your write up was like this illustrated notion that more uncertainty about growth equals higher values for growth stocks. And you showed the average of blanking on exactly what it was, but it was like 5% perpetual growth rate. Sorry, not
Yeah,
the
this
average.
was this what I was talking about before about the using you plug it into a dividend discount growth model. And basically if you're certain it's going to be grow at 5%, then it's worth $20. But if there's a 50% chance the growth is going to be 1% and a 50% chance it's going to be 9%, which works out to the same expectation. That's 5%. The average is 5%. The expected value more than doubles. And that's just the way the equation works. I don't know that that means you really, but if you believe that stocks should be valued according to the, future cash flows, then according to that valuation model, it should be higher than. I mean, one problem in that valuation model is if the growth rate exceeds the discount rate you apply in the equation, then the whole thing breaks and falls apart. So it doesn't answer all the questions about the world. It's just this interesting trait of the math there that something's worth more in the expected value if you run the numbers through the equations is higher if there's more uncertainty than if there's less.
Right. And, to tackle that problem, we have the two-step model, right? You could still get a sense of it. But, to bring it back full circle to this notion of rationality in markets, do you think that, investors do actually take that sort of rational discounting approach to this and they're actually thinking in those terms? Or do you think they're doing more of what I mused maybe was a problem in today's market? This stuff's growing, it's growing at an accelerating rate, so let me just buy it. Like, how much of it do you think is speculative
I mean, I
versus
think it's both. There's clearly both, and in an environment like now, you get more of that latter group because they succeed and they get more money. And I think that at this point is pretty widely accepted at places like the Booth School of Business at the University of Chicago, and there wasn't much. You can write papers talking about that, and it's totally fine now, and no one will yell at you like they would have in the 1970s. And then, I mean, the wonderful thing is Gene Fama wouldn't have yelled at you. He would have just said, "Let's see some evidence, man." But other people like Merton Miller, who won the Nobel in 1990, would have called you the enemy or said you're wasting time or whatever else. And now I think it's pretty widely accepted. No, those are clearly important. People extrapolating recent results to the future is a really essential part of how financial markets work and how prices are set, at least over sort of the short to medium term.
And so with AI, with everyone having access to AI, you'd mentioned in the past that maybe the information edge was not really a true edge in markets. Like, do you think that's basically gone for good? We could put that away?
I I mean I'm torn on that because my experiences so far trying to use mainly Chat GPT to sort of find information in a free form way. I've very often been disappointed. I mean, it's sort of well, not disappointed. It still takes a lot of judgment on the user's part to figure out what to take seriously and to look at something and think, "Oh, I think you hallucinated that," or whatever else. I think there are more systematic things you can do with it that's not an issue, but it just seems like I mean, it's a very tiny minority of investors now, but people who are actually out there digging up new information about companies, that's still a thing. And it might become more of a thing as others become more reliant on AI just searching. Because, AI can't go through the trash bins in the back of the corporate headquarters, which I don't know if anybody actually does that, but I bet some people do. It's sort of limited to what it can go through. And so, I mean, and I think Sam Altman has said that he thinks that, that it's going to be this huge increase in value for sort of bespoke services that only people can provide in a world where OpenAI succeeds. And I think there's still it's a room for a relatively small minority, but I think there's still clearly room for that in markets. But it is funny. I mean, I think in the end, a lot of at least people who succeed over really long periods of time in at least keeping up with the market indexes or beating them, it's almost more. It's like personal traits more than their how much information they dig up. It's just sort of this willingness to be the right amount of contrarian because you can't. I mean, I think Michael Burry going and trying to short Nvidia, that's probably going to end badly for him. But there is this way to not do that, but also steer around when the market overshoots that actually does seem to work. Warren Buffett is sort of the cliche example, and we'll see if Greg Abel can do it too. But that's something that still exists, and it seems to me that's actually something that AI is not likely to displace at all.
Yeah, it seems like maybe the longer I do this, the more it seems like the actual edge is behavioral, where it's about
Yeah.
being rational when others are losing their minds.
Yeah, it's behavioral and also somehow setting up your business or training your clients or, in some places just, firing all your clients and investing your own money that allows you to do that. Because I think that's and that's sort of in my book, that's one of the big lessons out of it is Andre Schleifer and Rob Vishny just sort of making the point that exactly at the moment when you want really smart professional investors to bet against things is exactly the moment that those kind of people are getting yelled at by their clients and having money taken away from them. And it just that's the way the market works. And one of the things, and this is I think true all over academic finance now, is there's much more understanding. Like it's still the majority of it is about profit-seeking people and organizations trying to maximize profits. It's not all, the behavioral thing is still to some extent a side issue, but there's just this realization that those profit-seeking people, there are there are reasons why they're not doing what is best for markets all the time. They're trying to survive. And one of I mean, I've just been reading this new book by John Campbell of Harvard and Tarun Ramdurai of Imperial College London. That's sort of this personal view of personal finance and how it doesn't work for people. And one of their arguments in there is just that you think in general that competition will make will it, lots of businesses trying to serve customers' needs will deliver an optimal result. But in investing and finance, you've got customers generally sort of very high percentage of them misperceive, how to get where they want to go, and there's huge amounts of money being made in sort of snookering them from the perspective of financial services providers from really basic things like how banks work and how they charge fees and everything else. And so their argument there is, yeah, you can have all of these totally rational financial services providers, and that ends up with a really bad result for some large percentage of the customers.
I think a lot of it boils down to what you'd concluded the last time we spoke, which was that like incentives matter. And incentives, like the study of incentives, is really useful as it pertains to economics.
Yeah. Yeah, and I think this sort of the kind of Panglossian view of markets out of Chicago in the 60s and 70s just kind of forgot about that for a while. And then I think now it's back and people get that. And that leads to lots of interesting explanations of market behavior. It doesn't lead to some really simple overarching lessons like Merton Miller was dispensing
Well,
50,
Justin,
60,
this has been
70
an
years ago.
awesome conversation. I've really enjoyed revisiting some of these past themes and talking about what's on everyone's mind today. So thank you so much. And we should make it much sooner to have our next conversation.
Well, once I've actually like written this chapter and know what I think, I maybe should try again. I don't know.
That would be fantastic. Let's schedule it for once you get the book out there and we could
Yep.
talk about the real conclusion.
All right. Thanks a lot, Elliot. And thank you, John, wherever you are.
Take care.
All right. Bye-bye.
Thank you, Justin. Thank you, Elliot. This was fantastic. Really enjoyed the conversation, and I hope everyone listening did as well. Take care, everybody.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.